Larry Shover, Chief Investment Officer at SFG Alternatives in Chicago for his take. Larry, good afternoon, good morning, our time, good afternoon to you.
Yes.
Your take on the pullback, is it much needed? A lot of investors out today seeming to say, oh, this is necessary. We need to see this pullback today.
Yeah, I think we do. It's healthy. I mean, we haven't moved that much considering how much we've moved since February 10th, February 11th. A lot of it just on systematic programs. Yes, we had some very good economic numbers, stability in China, et cetera, but boy, it was very negative down there at the lows. It seems to be getting a little bit more positive up here. It's really healthy for us just to remain in a very tight range for a while before we make our next move.
So what will the next move be? What will the next catalyst be for markets? Will it continue to be the oil price, or will it be all these central bank meetings coming up?
You know, I think it's going to be central bank meetings. You know, I hate to say this, but I think oil is going to start taking a back seat, given it's rallied $10. And yeah, it moved 3.5% today. But I do think the next catalyst is going to be the central bank meetings. There's a lot of expectations on Thursday's meeting with the ECB. Are they going to expand LSAP? Are they going to cut deposit rates? Are they going to expand the whole long-term refinancing options, et cetera, And then we have the Bank of Japan. Some of us are worried about maybe a snap election in June or July in that country. So their meeting is very, very important. So I think that's the next catalyst.
Larry, it's Gaurav Sodhi here in Sydney. I agree with you. The central banks, their actions are pivotal. But do you sense some skepticism from markets about the power of central banks? We've had sort of years of central bank action driving markets. Do they still have any legitimacy left?
Yeah, you know, that's perplexing because I feel exactly the same way. I mean, this is a policy experiment that we've never tried, or at least maybe not in 300 years as far as I know. And who knows how it's going to end up. But we do know that whatever they do is becoming less and less potent to the economy and more troublesome to the economy when you add the fact that global growth is slowing, industrial production, same thing. Worldwide debt continues to increase. So, yeah, it is troubling. It's perplexing because I think there's far too much emphasis placed on especially the FOMC, which I didn't mention, but also the ECB coming up this Thursday.
Yeah, and it's interesting because you've got stimulus obviously expected to come out of Europe, more stimulus from Mario Draghi. You've got negative interest rates at various places around the world, and yet the US looks to be hiking rates.
Yeah.
How do you sort of play that out? How do you balance that out for things like the greenback?
Yeah, no, it's hard to. I think, first of all, that the dollar continues to have a valuation problem. Even though it has depreciated since the beginning of the year, I still think it has room to go down. That said, I don't think the market here has really gotten their head around the fact that central bank is going to continue to diverge. The Fed is going to raise rates this year. I even think it's going to happen in June. I mean, and I don't think the market's expecting that. They're going to raise rates while everybody else is lowering rates. Yeah, that should put upward pressure on the dollar. I just don't think it's going to happen as quickly as some of us believe.
Do you think they have to be careful, the US has to be careful with timing, with elections coming up this year and a lot of talk about the political situation there? Could that play into the Fed's decision of timing with a rate hike?
You know, I don't think so. I hate to think so, actually, because I don't think that's really their mandate. That's what they shouldn't worry about. But to your point, this is the first time in a long time that this election has been so chaotic. And you add on top of that, you know, the bruising that Merkel has taken over the European refugee crisis. And then you have Brexit. And then, like I mentioned before, perhaps a snap election in Japan. The political scene in these countries is a lot more volatile than we've seen in a long time. I don't think it will play in the Fed's decision, but it surely might play in the market's decision.
What sort of impact will that, just going back to the ECB meeting, because that's obviously the key catalyst for this week, what sort of impact do you expect that to have on US markets and global markets altogether if they do announce a solid stimulus plan?
You know, I think it'll just add stability and a tailwind to the market. I'm not saying that we're going to make that next leg up in the U.S. because right now I think people have to look at the S&P earnings and realize we can't really go that much higher right now. But it could create a tailwind of sorts, or at least some stability where we trade in a nice, tidy, boring range for the next few months.
Want to ask you as well about another catalyst that's coming up, and that's China data. We've obviously been talking with other guests about the China data we got yesterday, the trade numbers, but coming up this week, we've got quite a bit of data dropping out of China. I think on Saturday, a lot of numbers coming out and lots to watch there. Is the US very focused on this at the moment? There was a period there when all eyes were on the yuan fix every day. Any China data that dropped, the US markets reacted to quite strongly. Do you expect to see that continuing over the next few weeks, or are there too many other macro issues going on?
I don't think it's the macro issues per se. I mean, last night's number was shockingly bad. We all agree with that. Not because it's just bad, but it was consensus was way off the map. I mean, we had exports down 20.6%, imports down 8%. That was way off consensus, but yet the market kind of shrugged its shoulders. I think it's more about the fact that there's stability in the Chinese currency right now, and the outflows have not been as great as people have expected. I think that's equally as heavy of a tailwind, as it were, to bad economic data. I think the bottom line is that the market believes that somehow China has enough policy tools left to manufacture 6.5% growth this year. So we shall see.
And do you think the US economy has enough strength to sort of, I guess, withstand any issues that come out of China? Given some of the data we've been seeing out of the US recently has been quite strong.
Yeah, I think we do, and I think that data lags a lot longer, and the trend lasts a lot longer than most of us believe. I mean, low oil price, not maybe higher wages per se, but more people employed, the construction spending, et cetera. That's a massive tailwind for consumers, for the service sector. Wages have not inflated as much as most of us would like to see. However, when you have full employment in the U.S., I don't see that changing anytime soon.
Larry Shover, Chief Investment Officer at SFG Alternatives. Appreciate your time. Thank you.
Thank you.